Hi there, it's Friday the 7th of June 2019. I'm Steve Towers. Welcome to ITB. Let's get started. As you know, I haven't presented a regular ITB show since the 17th of May, which is 3 weeks ago. There are a number of important stories which emerged during the first 2 weeks. I've included those stories in today's show, but to distinguish them from this week's stories, they're marked as catch-up stories on the relevant slides. Well, the number one topic this week is, of course, the so-called Programme of Work on Digital Taxation released by the OECD's Inclusive Framework. This will be discussed and very likely endorsed by the G20 finance ministers at their meeting in Japan this weekend. For a copy of the document, please go to our website or app. Now, let me take you through the highlights of the document. My first comment is that the title says it all. Programme of Work to develop a consensus solution. There's no consensus solution just yet. In fact, if all goes to plan, the outlines of the architecture of the consensus solution will emerge in January 2020, and the final report will be delivered by the end of 2020. The document says this: a consensus-based solution to be agreed among the 129 members of the Inclusive Framework will, in addition to the important technical work that must be carried out, require political engagement and endorsement, as the interests at stake for members go beyond technical issues and will have an impact on revenues and the overall balance of taxing rights. For a solution to be delivered in 2020, the outlines of the architecture will need to be agreed by January 2020. This outline will have to include a determination of the nature of and the interaction between both pillars, and will have to reduce the number of options to be pursued under Pillar 1. Throughout 2020, the Inclusive Framework, Steering Group and working parties will work on agreeing the policy and technical details of a consensus-based long-term solution to the challenges of the digitalisation of the economy, and will deliver a final report by the end of 2020. In fact, the Programme of Work shows exactly the same pillars and proposals as were set out in the policy note, which was approved by the Inclusive Framework on the 23rd of January. So there's been no reduction in the number of alternatives since then. However, it is fair to say that the Programme of Work does show a significant amount of detail in regard to the issues which will need to be addressed in assessing the alternatives. Also, the inference from the document is that both Pillar 1 and Pillar 2 will be part of the solution. In other words, the solution will not be Pillar 1 only or Pillar 2 only. The document starts by considering the revised profit allocation rules under Pillar 1. 3 alternative profit allocation methods are described. Firstly, a modified residual profit split method. Secondly, a fractional apportionment method. And thirdly, so-called distribution-based approaches. An important point to note is that these methods are either formula-based or use arbitrary benchmarks. The modified residual profit split method is described in this way. The MRPS method would allocate to market jurisdictions a portion of an M&E group's non-routine profit that reflects the value created in markets that is not recognised under the existing profit allocation rules. It involves 4 steps. 1. Determine total profit to be split. 2. Remove routine profit using either current transfer pricing rules or simplified conventions. 3. Determine the portion of the non-routine profit that is within the scope of the new taxing right, that is, under the revised Nexus rules, using either current transfer pricing rules or simplified conventions. And 4. Allocate such in-scope non-routine profit to the relevant market jurisdictions using an allocation key. The formulaic aspect of this method is clearly stated in Step 4, the allocation key. The references to simplified conventions in Steps 2 and 3 are either to the use of formulae or to arbitrary benchmarks. The document emphasises the advantage of using such simplification measures in order to limit the burden of the new rules on tax administrations and taxpayers alike. The document sets out a detailed list of issues to consider with the modified residual profit split method. 2 of those issues in particular are noteworthy. Firstly, should accounting rules be used for the computation of total profits? And if so, what adjustments, if any, would be appropriate? And secondly, should total profits be determined on a group-wide basis or on an entity or aggregated entity basis? And if the answer is group-wide basis or aggregated entity basis, how should the particular entity or entities which will be subject to the new taxing right be identified? The second alternative profit allocation method is the fractional apportionment method, which is described in this way. The fractional apportionment method involves the determination of the amount of profits subject to the new taxing rights under the revised Nexus rules without making any distinction between routine and non-routine profit. One possible approach to assessing the profit derived by a non-resident enterprise is to take into account the overall profitability of the relevant group or business line. This method would involve 3 steps. 1. Determine the profit to be divided. 2. Select an allocation key. And 3. Apply this formula to allocate a fraction of the profit to the market jurisdictions. In regard to Step 1, determine the profit to be divided, the document describes the issues to be considered. Determining options for the starting point of the computation of the relevant profits subject to the fractional apportionment mechanism. Such options may include the profit of the selling entity as determined by the current transfer pricing rules, or by applying a global profit margin to local sales, or by any other measures as may be considered appropriate. The highlighted option, applying a global profit margin to local sales, is the mechanism which is commonly used in India, which is the major proponent of this fractional apportionment method. The third alternative profit allocation method is called distribution-based approaches. The document says this. One possibility would be to specify a baseline profit in the market jurisdiction for marketing, distribution, and user-related activities. Other options might also be considered. For example, the baseline profit could increase based on the M&E group's overall profitability. Through this mechanism, some of the MNE Group's non-routine profit would be reallocated to market jurisdictions. The baseline profit could also be modified by additional variables to accommodate, for instance, industry and market differences. This methodology seems to be inspired by the proposal made by Catherine Amos of Johnson & Johnson in the public consultation in March. The document sets out a number of issues which might be common to two or more of the methods. Should business line or regional segmentation be used? Should there be some scope limitations? For example, safe harbours or revenue thresholds? And are there other design limitations? For example, in regard to trade regulations? And how should losses be treated? The document then turns to the revised Nexus rules. There are two main issues which are considered. Firstly, the necessary amendments to double tax treaties. And secondly, the identification of the nexus conditions. In regard to the amendments to double tax treaties, two approaches are identified. The first approach is to amend Article 5 to deem a PE to exist if the new nexus conditions are satisfied, and also to amend Article 7 to attribute to the deemed PE the profits allocated under the revised profit allocation rules. The second approach is to leave Articles 5 and 7 untouched, but to insert into the treaty a new provision which would allow source country tax to apply if the new nexus conditions are satisfied, and to the extent of the profits allocated under the revised profit allocation rules. As currently written, Article 7 would allow this specific provision to apply. And in regard to the new nexus conditions, the document describes the program of work in this way. The evaluation and development of indicators of an MNE Group's remote but sustained and significant involvement in the economy of a market jurisdiction. This would require A sustained local revenue threshold, both monetary and temporal, and B, a range of additional indicators which, in combination with sustained local revenues, would be taken to demonstrate a link beyond mere selling between those revenues and the MNE's interaction with the economy of a jurisdiction. Those highlighted words, beyond mere selling, reflect the view expressed in the February consultation document that favourable demand conditions in the market jurisdiction that exist independent of the actions of the firm will not satisfy these conditions. The next topic considered by the document is the implementation of the new taxing right under Pillar 1. 3 subtopics are covered: elimination of double taxation and dispute resolution, administration of the new taxing right by the tax authorities, and how to modify double tax treaties. And yes, the MLI is one of the options. In my view, the most interesting issue here is this. The proposals under Pillar 1 may, depending on the design options eventually chosen, envisage reallocating taxing rights over a proportion of an MNE Group's profit, however defined, rather than over the profit from specific transactions or activities undertaken by particular separate entities. It may therefore not be immediately clear which members of an MNE Group should be considered to derive the relevant income. This leads to questions about how, in practice, source jurisdictions would exercise the reallocated taxing rights, and how residence jurisdictions would provide relief from double taxation of the relevant income. The implementation of any of the Pillar 1 proposals would first require identifying the taxpayer who bears the tax liability and the filing obligations. Where the tax liability is assigned to an entity that is not a resident of the taxing jurisdiction, it would be necessary to address the required enforcement and collection arrangements. Pillar 2 deals with the global minimum tax, which the document calls the GLOBE proposal, the Global Anti-Base Erosion Proposal. As outlined by the OECD earlier this year, this proposal consists of two interrelated rules. An income inclusion rule that would tax the income of a foreign branch or a controlled entity if that income was subject to tax at an effective rate that is below a minimum rate, and a tax on base eroding payments that would operate by way of a denial of a deduction or imposition of source-based taxation, including withholding tax. In regard to the ordering rule for these two rules, the document says this: the two rules are intended to affect behaviour of taxpayers and jurisdictions alike, which is expected to limit the revenue impact of the rule order for jurisdictions. Rather, rule order will need to be determined by reference to principles of good rule design, including effectiveness, simplicity, and transparency. In regard to the income inclusion rule, the document identifies a number of interesting issues, including these: whether the minimum rate of tax should be a fixed percentage or instead a percentage of the parent jurisdiction's tax rate. The document seems to prefer a fixed percentage, but it gives no clue as to what that percentage would be. Different options for rate blending. The possible use of carve-outs, for example, for regimes which are compliant with BEPS Action 5, or for a return on tangible assets, which is obviously a reference to GILTI, or for controlled corporations with related party transactions below a certain threshold. And in regard to foreign branches, the use of a switchover rule to switch from an exemption method to a credit method. In regard to the tax on base eroding payments rule, the major issues concern amendments to double tax treaties, in particular in regard to the imposition of source-based taxation, including withholding tax. For both rules, the document indicates that the inclusive framework will explore compatibility with international obligations, such as non-discrimination, including for EU members, the EU fundamental freedoms, and how that compatibility could depend on each rule's detailed design. Two other topics I should mention are the economic analysis and progress reports and public consultations. An important part of the program of work will be an economic analysis to inform members of the inclusive framework of the likely revenue impact of the various proposals in regard to specific jurisdictions and in regard to specific industry sectors. The document says this: the timing of the economic analysis work will need to be phased in such a way as to deliver members of the inclusive framework with the information required to take decisions at key milestones. Thus, the program of work will require analysis to be provided to members by the end of 2019. The document states that a report on the progress of work is expected in December 2019. Presumably, this means that the progress report will be issued to the G20 finance ministers and released to the public. In regard to public consultations, the document is non-committal. Consideration will be given to the holding of public consultations as necessary in order to obtain stakeholder feedback as the various proposals are refined. In New Zealand, the government has released for public comment a discussion document called Options for Taxing the Digital Economy. This is part of the government's decision-making process as to whether or not to introduce a digital services tax at a rate of 2 to 3% as an interim measure, or merely wait for the development and implementation of the Inclusive Framework's long-term consensus-based solution. Public comments are requested by the 18th of July. For a copy of the document and the government's press release, please go to our website or app. And in France, the DST bill was passed by the Senate, but with a key difference from the version which has been passed by the lower house, the National Assembly. The Senate version has a 3-year time limit. The next step is for a joint committee of the Senate and National Assembly to negotiate a final bill. Well, there's never a dull moment in regard to US trade rules. The biggest topic right now is arguably not the US-China trade war, but instead the US plan to impose a 5% customs duty on all imports from Mexico, effective this coming Monday, the 10th of June. This initiative is intended to be leverage in border security negotiations between the two countries. The latest indications are that although the negotiations are making significant progress, the US remains on track to impose the levies on Monday. The US-China trade war doesn't seem to be any closer to resolution. The action seems to be moving from tariffs to other issues, such as access to markets. However, there is some good trade news to report. Canada and the US have agreed to remove tariffs and surtaxes on imports of steel, aluminum, and various consumer and industrial goods. And the US has postponed for 6 months tariffs on motor vehicles and parts imported from the EU and Japan. The OECD has scheduled its next Tax Talks webcast for Tuesday of next week, starting at 2:30 p.m. Paris time. To attend the webcast, you will need to register, and to do that, you can find the link at our website or app. And the Tax Justice Network has released a report on corporate tax havens. The report ranks 64 jurisdictions according to a range of factors. TJN's headline is that in the top 10, there are 4 jurisdictions under UK control. I was interested to see where the US ranked on the list. It's at number 25. Apparently, individual US states were not assessed, which I guess is the reason that Delaware didn't make the top 10, whereas the Netherlands, Switzerland, Luxembourg, Singapore, and Hong Kong all did. To obtain a copy of the report, please go to our website or app. The Australian and New Zealand governments have agreed an administrative approach in regard to the residence tiebreaker rule in Article 4.1 of the MLI. You'll remember that under Article 4.1, for a non-individual person which is a resident of both contracting jurisdictions, the competent authorities of the contracting jurisdictions shall endeavour to determine by mutual agreement the contracting jurisdiction of which such person shall be deemed to be a resident for the purposes of the covered tax agreement, having regard to its place of effective management, the place where it is incorporated or otherwise constituted, and any other relevant factors. Under the administrative approach, for a taxpayer which satisfies all of the eligibility criteria, the two tax authorities will accept the taxpayer's reasonable self-determination that its place of effective management is in either Australia or New Zealand, and that taxpayer will then be deemed to be resident in either Australia or New Zealand for the purposes of the Australia-New Zealand Treaty. As you would expect, the eligibility criteria includes having a good tax compliance record in both countries. This applies to all members of the taxpayers group. Also, the eligibility criteria exclude large groups. Only groups with annual revenue less than 250 million Australian dollars or 260 million New Zealand dollars can qualify. For a copy of the administrative approach, please go to our website or app. In Cambodia, the government has announced that the 1% minimum corporate tax on annual turnover will be removed, effective the 30th of May. The minimum tax previously applied generally to self-assessment regime companies which did not keep appropriate accounting records and have an annual external audit report issued by a recognised audit firm. For a copy of the government's press release, please go to our website or app. In China, the government has issued Announcement 72 of 2019, which increases the deduction limit for insurance companies in regard to expense handling fees and commission expenses. For a copy of the announcement, please go to our website or app. I have two cases from India which I can run through very quickly. The first case is called Reliance Jio Infocomm. It's a decision of the Mumbai Income Tax Appellate Tribunal. This case concerns payments made by an Indian company to a Singapore company for the provision of bandwidth services. Importantly, the Indian company had no access to or control over the equipment which was used by the Singapore company to provide the services. Even though the definition of royalties in Article 12 of the India-Singapore Treaty includes payments for the use of or the right to use any industrial, commercial, or scientific equipment, the tribunal correctly held that the payments did not fall within the definition of royalties under the treaty. And the second case is called Michelin. It's a decision of the Delhi Income Tax Appellate Tribunal. This is another case in the long line of Indian transfer pricing cases in regard to excess expenditure on advertising, marketing and promotion. We're still waiting for the Supreme Court to finally resolve the situation. But this case concerning Michelin is particularly interesting for two reasons. Firstly, the Indian distributor's AMP expenditure was fully reimbursed by its French parent. The tribunal held that because of the reimbursement, the AMP expenditure was covered by an international transaction, and thus it fell within the scope of India's TP rules. And secondly, the tax authorities sought to disallow the Indian distributor a deduction for a large portion of its AMP expenditure, which is a relatively unusual move. However, the tribunal rejected that disallowance. For a copy of these two Indian cases, please go to our website or app. In New Zealand, the government has announced that it intends to amend the GST rules on telecommunication services to align them with the OECD guidelines and with the treatment of other remote services. The effective date for the amendments will be the 1st of October 2020. The tax authorities have released for public comment an issues paper on the proposed change. Public comments are requested by the 28th of June. For a copy of the issues paper, please go to our website or app. The EU has announced updated lists of non-cooperative jurisdictions for tax purposes. 3 jurisdictions, Aruba, Barbados and Bermuda, have made the necessary changes to enable them to be removed from the main list in Annex 1. Barbados and Bermuda have been moved to the so-called grey list in Annex 2, whilst Aruba has been removed completely from both lists. With these changes, 12 jurisdictions remain on the main list: American Samoa, Belize, Dominica, Fiji, Guam, Marshall Islands, Oman, Samoa, Trinidad and Tobago, UAE, US Virgin Islands and Vanuatu. For a copy of the announcement, please go to our website or app. The European Commission has published the documents which relate to the most recent meeting of the VAT Committee. Here is the list of documents. Please hit the pause button if you'd like to study the list. And if you'd like to obtain a copy of the documents, you can do so at our website or app. In Hungary, the government has announced a package of tax changes called the Economy Protection Action Plan. 2 items caught my eye. Firstly, advance payments of corporation tax will be abolished for companies with an annual turnover in excess of 100 million Hungarian forints, which is about $350,000 US. This will give such companies use of the cash for 5 more months. And secondly, advertising tax has been deferred from the 1st of January 2020 to the 31st of December 2022. For a copy of the government's announcement, please go to our website or app. In Italy, the tax authorities have published guidance in regard to foreign tax credits and the patent box regime. The guidance says that due to the reduced effective tax rate which applies under the patent box regime, a taxpayer which receives foreign income which is covered by the patent box and which has suffered foreign tax will have their foreign tax credit reduced proportionately. For a copy of the guidance, please go to our website or app. In Poland, it looks like the mandatory VAT split payment system for certain B2B transactions will commence on the 1st of September after all. It had earlier been reported that the new system would start on the 1st of January 2020. Voluntary split payments have been available since July 2018. In Switzerland, the referendum for the proposed federal tax reform legislation known as TRAF was passed. In the UK, the government has released for public consultation draft regulations in regard to the legislation on offshore receipts in respect of intangible property, which is commonly referred to as ORIP. The ORIP charge was announced in the 2018 UK budget, and the legislation generally applies from the 6th of April 2019. The draft regulations will make a number of changes, including these. The extension of the charge to companies which are resident in jurisdictions which have full double tax treaties with the UK, but which enjoy a tax benefit in those jurisdictions. Two examples are, firstly, the Barbados International Business Company, and secondly, a Singapore company which derives unremitted foreign source income. There will be a new exemption for companies resident in specified jurisdictions, which are considered not to pose a revenue risk for the UK. The jurisdictions have not yet been specified, but they will be in the coming months. And changes to the definition of UK sales in relation to distributors and resellers. Public comments are requested by the 19th of July. For the link to the consultation website where you can find all the relevant documents, please go to our website or app. In Ghana, the government has responded to a significant revenue shortfall by replacing the senior executives at the Revenue Authority and by rotating the roles of over 1,400 Revenue Authority staff members. In Nigeria, the government has announced that banks will be required to collect VAT on online transactions involving purchases of goods and services. Now, to be clear, this is not a new imposition of VAT. It's a mechanism to collect VAT, which apparently is not being fully collected at present. In Zambia, the tax authorities have published on their website an updated version of the very long list of goods and services proposed to be exempt from sales tax, which will replace VAT on the 1st of July. For the link to the tax authorities' website, please go to our website or app. In Oman, the government has suspended for 3 years the 10% withholding tax on dividends and interest paid to non-residents. In the US, the government has released final regulations in regard to Section 956. For a copy of the regs, please go to our website or app. And also in regard to Subpart F, the government has issued proposed regulations in regard to the stock ownership attribution rules in Section 954. Commentators have noted that the proposed regs don't deal with the repeal of Section 958B4, which is a current hot issue. For a copy of the proposed regs, please go to our website or app. And this week, the government has released 2 sets of regulations in regard to real property. The first is final regulations on transfers of property to REITs following corporate distributions. And the second is proposed regulations in regard to investments in US real property by foreign pension funds. For a copy of the 2 sets of regs, please go to our website or app. And if you're looking for a good overview of the GILTI and FDII provisions, the US Joint Committee on Taxation has produced it for you. For your copy, please go to our website or app. And now for this week's treaty developments. We've had 4 treaties signed, 3 protocols signed, 1 treaty enter into force, and 1 protocol enter into force. I have 3 articles for you this week. I'll cover the first 2 articles together because they both deal with the same topic, the use of the English language in double tax treaties. The first article is called Comment from a German Language Perspective. It's written by Michael Wichmann and it's published in the IBFD's Bulletin for International Taxation. And the second article is called The OECD BEPS Multilateral Instrument and the Issue of Language. It's written by Richard Xenophon Resch and it's published in Kluwer's Intertax Journal. Michael Wichmann's article is a response to an article published earlier this year by John Avery Jones called Why Can't the English? In that article, Avery Jones suggested that the English language version be used as the only authentic version of bilateral tax treaties concluded by English-speaking countries. You might remember that I covered that article in ITB on the 5th of April. Wichmann's article contains a number of interesting examples which show that even between countries which share a common language, interpretation difficulties can exist. One example is this. The revising protocol concluded in the German language to the Germany-Switzerland Income and Capital Tax Treaty required a special footnote due to the persistent difference in just 2 letters of the term for pending mutual agreement procedures between the alternate versions for Germany, Anhängigen, and for Switzerland, Hängigen. And another, the informal, for information purposes only, German translation of the MLI